Good afternoon, everyone, and welcome to this month's installment of Epic Insight. This is Joe Corona. I'm a sales consultant at Epic Retirement Plan Services, and I'll be your host and co-presenter for today's cash balance tune-up session. Joining us today to ensure that you're cash balance savvy is Matt Pine. Matt heads up Epic's Defined Benefit Actuarial Services team out of our Portland, Maine office. He is a fellow of the Society of Actuaries and an enrolled actuary with over 16 years of industry experience. Matt consults with clients on a variety of issues, including plan design, funding strategies, and pension risk management. He received his bachelor's degree in mathematics from Hillsdale College and a master's in applied statistics from Eastern Michigan University. A quick reminder before we get started that your line will be muted throughout today's session, but if you have any questions, please enter them in the question panel on your screen, and we will address them at the end of the session. And with that, I will turn it over to Matt.
Thank you, Joe, and good afternoon, everybody. Thank you for joining us. Today's session will be a high-level review of cash balance plan, key characteristics and information that may help you if you have a prospective client that you think cash balance could be a good fit for. So just a couple of observations before we get started on trends that we've seen over the past couple of years. The first is that one thing we've noticed with certain employment shortages is that some plan sponsors are enjoying the benefits of cash balance and the fact that it can be used as an employee benefit. We've seen some plan sponsors adopt cash balance not only for the significant benefit that goes to the owner, but also as an additional employee benefit that can help them retain key employees. The second is that the higher interest rates and inflation that we've seen over the years has, as you know, impacted the deferral limits for 401k plans. It's also substantially impacted cash balance contribution limits, and it's increased those pretty significantly. And I'll show you an illustration of that in the past. So we do have some plan sponsors who may have already maxed out the potential with the cash balance plan who are revisiting it again because the limitations have increased so much in the past year. Okay. So cash balance plans are really a defined benefit plan, but they have certain distinctions. So what makes these unique from defined benefit is really how they're described in the benefit formula. The common characteristic of a defined benefit plan or cash balance plan is that there's a contribution credit. There's a hypothetical account balance for participants. It's not a real account balance. It's really a hypothetical, but that balance grows with contribution and interest credit annually, similar to what you would see with something like a defined contribution 401k. So participants have a much greater visibility and understanding of cash balance plans rather than defined benefit, but these are still defined benefit in nature, and so they follow all the IRS defined benefit plan rules. One of those is that the benefit formula, in this case the pay and the interest credit, need to be determined in advance by the plan sponsor and the actuary. So part of the process of adopting a cash balance plan is really to define the benefit in the design stage. So typically the actuary tries to accomplish whatever the plan sponsor's objectives are in terms of how much they want to save. From time to time you can amend the plan, but it's not a discretionary formula that you can change from year to year. So that's typically reserved for defined contribution plans. Probably the greatest advantage of cash balance over their defined benefit counterparts is that the benefit is generally paid as a lump sum. So almost all the time we see participants take their benefit in the form of a lump sum. The benefit really, from a participant, the owner standpoint, is an account. And when they retire or terminate, they have the ability to take that money and to roll it directly into an IRA and then invest it along with their assets that they may have in an IRA. Contributions, however, because this is a defined benefit plan, there is a valuation that's required. This is sort of kind of the downside, is that there is an annual calculation in order to determine what is required to be funded to the plan. Typically what we see is that the pay credit, which is being targeted, is usually the recommended contribution. There is generally a range, a minimum and a maximum, so there is some funding flexibility every year, but there is a calculation required by the actuary to determine what is actually required and what can be funded during the year. Okay, so reasons to establish a cash balance plan. The big picture is that these are qualified retirement vehicles. It's one of only a couple opportunities that the IRS provides for plan sponsors or individuals to put away money on a tax-deferred basis. So that's really what this is all about. It's an opportunity to defer taxes down the road, allow business owners to put aside money during peak earnings years and allow that to grow tax-free and to ultimately, be paid out down the road, hopefully when owners at a lower tax rate. So what we do find is that for small business owners, these can be very compelling. Oftentimes, sole proprietors or small S corps where there may be an owner or two along with a few employees. There can be pretty compelling availability for deferrals into a cash balance plan. We'll talk about this in a slide from now. Typically, the deferral limits increase based upon the owner's age, but we still see these plans be very attractive to what I would call younger owners, business owners who may be starting to enter peak earnings years. These are also very popular with partnerships. You might think of something like a law firm where partners may be maxing out a profit sharing type of defined contribution plan, and by layering on top a cash balance plan, they have the ability to defer a significantly higher amount of money. And again, because these are qualified plans, that money is protected. It's protected from items like bankruptcy and creditors. It follows and has all the advantages of any type of qualified retirement plan. And the last, but probably not the least, is the benefit to employees. So, these are retirement programs. There are discrimination testing requirements, and so while the business owners may reap the vast majority of the benefit, there are certain amounts that have to be provided to employees, and so this is a perk for employees, and it's something that should be paid broad attention to, and it can help in some cases. It's it is a useful retention tool for employees. Okay, so recently the IRS came out and they updated their deferral limits for 2023, and I think, as probably everyone is aware, the cost of living increases were significant. I think there was something like around 8%, and so increases in the amount that employees can contribute to their own 401k increased pretty significantly. The same is true for the cash balance plan contributions. So the way that a cash balance limit works is a little different than the defined contribution. It's because it's a defined benefit plan, the limits are actually described as an annuity and an amount of annuity at age 65. And as a result of that, there's a calculation annually to determine what a owner can put in, how much they can benefit during a given year. The younger they are, the smaller the present value of that age 65 annuity. It's not quite intuitive, but the way that the math shakes out is that owner or individual who's in their 60s could increase or have a benefit level that's well over $300,000. And even in the mid-40s, the potential may be around $150,000. And again, these amounts have increased over last year by about 8%. So in total, for a plan that's run for approximately 10 years right now, the maximum lump sum payout for a 62-year-old individual is about $3.4 million. It takes about 10 years to max out, assuming the individual is the right age and contributes to the highest level possible. But in a time frame of 10 years, there's the potential to accrue a benefit of $3.4 million. That's just something that wouldn't be possible within the 401k. Okay. So now we have some plan design considerations. And, this is really the stage. This is what the actuary and Epic's team in particular does bring to the table is experience with plan design. But here's some characteristics, some common characteristics of cash balance plan design. So the pay credit that referred to earlier that employees and the owners would get can either be defined as a flat amount, annual amount, or it could be something that's a percentage of pay. And if it's a percentage of pay, then it has the ability to fluctuate somewhat as the owner's pay fluctuates. Ultimately, the benefit level is subject to Section 415 limitations. So there are maximum accruals during the year, which is really what I referred to and showed on the last slide. At the highest level, you may be looking at something over $300,000 for an individual who's the right age. On the other hand, there's also minimums. One of the common questions we may receive is, does everybody have to get a cash balance account, or can just the owners? And the rules require that 40% of employees must receive a meaningful benefit under the plan, which could be around 2 or 3% of pay. So these plans do have all the other standard non-discrimination testing requirements, and there's an annual non-discrimination testing calculation performed. At a minimum, 40% of the employees have to receive a cash balance plan, but there is some discretion on who receives that. That's really up to the business owner. The interest credit rate, which is annually credited based upon the hypothetical account balance. There are a handful of approaches in terms of how you what interest credit rate you choose. What's most common is a fixed rate. A fixed rate of 4 or 5% are very commonly used in the industry. Up to 6% is permitted. A bond-based rate, such as a 30-year Treasury, that used to be popular. When Treasuries fell low, those really fell out of favor. That it's potentially something that we may see become a little bit more common, with Treasury rates being higher now than they were the past decade. And then an actual rate of return on plan assets is a newer approach. The IRS clarified some rules in 2015, and there is the ability to use an actual rate of return on plan assets, although there are some complications, some complicating factors with using that approach. It's not right for everybody, but it is an option. But the far most common approach that we see is the fixed rate approach. Plan vesting can follow a 3-year cliff vesting schedule. That's by far the most common. So individuals who don't work for 3 years lose their cash balance benefit. So that's a nice feature too. If you have high turnover, then the plan asset or the accrual stays with the employer. It doesn't get paid out to the employee. And then finally, the other common area of concern or common topic is plan permanence. So the IRS frowns on the idea that a cash balance plan would be established and used as sort of a tax haven for 1 or 2 years of high income. So there's a requirement that the plans be established with a permanent objective. There are a whole list of reasons why a cash balance or defined benefit plan can be terminated early, lots of legitimate reasons. But to go into a cash balance plan knowing of only 1 or 2 years of large income could certainly be a problem in the IRS's view. If it would terminate after only 2 years, it would be pretty high potential for that plan to lose its qualification status and really lose the whole benefit of the plan. Okay. Investment considerations. This is one area where we do receive a lot of questions. Epic is not an investment advisor, but we do see and experience a lot of different investment approaches. One of the most common is to target the plan's interest crediting rate. A very common question is what happens if assets exceed that rate, or what if assets fall below that rate? So say you have a plan with a 5% interest crediting rate. Typically what happens is that if you consistently exceed that rate, then generally over time, and usually not dramatically, you may see lower future contribution requirements, which isn't necessarily a bad thing unless the whole purpose of the plan is to reduce taxes. On the other hand, if investments fall short of that interest crediting rate consistently, then what you might expect is increased contribution requirements over time. And so for that reason, it's fairly common to see a more conservative investment allocation approach in order to sort of minimize the asset volatility. Oftentimes within a profit sharing only plan, the asset allocation or the risk allocation may be higher than what you see in a cash balance plan. There may be opportunities or there may be times when higher risk is appropriate in a cash balance plan. It depends very much on the individual's circumstances. So one approach is not always the best approach for another plan. There are certain characteristics, things like the time frame, that could impact things as well. So typically these plans are run for up to 10 years, sometimes shorter than that. And as you get closer to sort of the end state, or what we call where the plan terminates, it may be appropriate to sort of dial back the risk and to avoid the potential for something like an equity correction, which could lower the value of assets at the time that you're hoping to pay them out on a fully funded basis. So this is one area of what I would call complication, where it's important to have a good relationship with your TPA and your actuary to understand the risks and to know how to properly manage these plans, because when they are managed well, they tend to work out well. Okay, so we have a sample plan design. This is a design that I would say is sort of a common type of plan demographics, where you may have 1 or 2 owners and a handful of employees. In this case, there was an owner and the owner's child who was also an owner, and they both had significant income. The first owner was far older than the second owner, and then they had a few employees. And this organization really definitely took care of their employees in terms of the profit sharing. They liked to provide a strong profit sharing contribution, and ultimately when we implemented the cash balance plan, we didn't have to increase the profit sharing amounts above what they were already providing to their employees. We did have to reduce the profit sharing component that they were receiving, and that had to do with some of the deduction limits when you have a defined contribution and a defined benefit cash balance plan together. But even after reducing the profit sharing plan, they were able to get a pretty significant increase within their cash balance plan benefit. And the total retirement dollars that were being spent by the company ended up being or are about $550,000. 92% of that is direct owner benefit dollars, about $500,000 to the benefit of the owners, and a pretty significant tax savings from implementing this plan, not to mention the ability for the company to put away dollars quickly, and especially near the end of the career for the older owner. So not all prospects work out. Oftentimes, the demographics may not shake out well, and the percentage of benefit going to the owners may be lower than you'd like. Sometimes there's no way to know until you have an illustration and you see how it shakes out. But sometimes the numbers can be quite compelling, like in this case here. So that is bringing us to the end of my presentation, and at this point, I'm going to turn it back over to Joe Corona for some tips on getting started with cash balance.
Well, thank you, Matt. Appreciate it. And as we've seen, cash balance plans can be a complicated subject matter, but we will do everything we can to help arm you with as much information to make it as easy as possible for you to deliver the value of a cash balance plan to your clients and or prospects. At the end of the day, if your client is looking to save more on taxes, it's worth taking a look. We have a simple web form that you can complete to request a study from our actuarial team. And typical cash balance candidates that we see are high income earners that are looking for additional ways to defer significant amounts of money above and beyond the limits that are in place for 401k plans. So you saw the illustration that Matt had up earlier. We had 2 business owners and 3 staff, with the 2 business owners having higher incomes, and we were able to defer quite a bit for them within the 401k plan. The employers typically have a 401k plan already in place, and they're reaching those maximum limits within the 401k plan, so they're looking for something above and beyond what they can contribute to their 401k plan, and that's where the cash balance can really be an opportunity for them to defer additional amounts. And then another area that we always are looking at are solo Ks. Whenever you have a solo K or solo entrepreneur that's making more than $250,000 annually, combining a cash balance plan with a solo 401k can have a great deal of benefits with some more limited testing that's required because there are no other employees. As with any questions that may arise as you're talking to clients, if you have any questions, you can always run it by one of our Epic sales consultants. Moving on to the investment side of things, obviously there's a couple of different ways that you can manage the pool of assets that helps to support the plan. If you'll be managing the pool of assets, obviously you could select the custodian of your choice, and we request that you have duplicate statements sent to our team to do our annual valuation work. If you don't think you have the expertise in-house to handle the cash balance investing and want some assistance, we can certainly partner with you on that piece. So we encourage you to reach out to your Epic sales consultant and we can talk through the different options that are available for you from the investment side. With that, we will turn over to some questions, and we do have a question that came in, Matt. This question is, how can the cash balance cover owners only? Doesn't the plan need to cover some non-owners?
Yeah, that's a good question. And the requirement is that a cash balance plan has to cover 40% of the staff. So in that prior example, there were 5 employees and only 2 were required to benefit. So that's the requirement. There are other discrimination tests that have to be passed that the employees are receiving enough benefits through the 401k plan. So ultimately what we do is we combine the cash balance and defined benefit plans together and run discrimination tests. And in the case of the illustration, they passed with flying colors, but and oftentimes we're able to restrict the cash balance plan to a select group of employees because you only need to provide it to 40% of employees.
Great, thank you, Matt. Well, that is all that we have for questions for today. A quick note to everyone that over the next day or so, you will receive an email with a link to the recording of today's session, as well as a copy of the presentation. In the meantime, we would love to partner with you to take a look at a cash balance plan for your clients. So we encourage you to reach out to your Epic sales consultant, and we can help navigate the process of submitting for an illustration, as well as gathering the data and the information needed from your clients in order for us to put together a proper illustration that you can share with them. We would like to thank Matt and his team and expertise, and thank you all for tuning in to our Epic Insight and for your ongoing partnership. And we want to wish you and your families a happy and healthy Thanksgiving holiday. Thank you.